But let me bring you over to my chart of the day, if not the week, and this basically looks at how many trillions we've lost in the world market cap. Now, a lot of this is emerging markets. A lot of it is actually the non-emerging markets. How much more of a correction will we get?
You know, I think the valuations are slightly expensive in the US, and the valuations are just about fair in EM right now. So I'm anticipating a little more correction from out here, about 5 to 10% correction, and largely driven by the non-US markets, actually, because I think US markets, you're still seeing earnings being relatively robust, right? So although the market is expensive, the earnings are there to back it up, whereas the earnings revisions in the rest of the world are not that hot, especially in EM, where earnings are actually being revised down. I think that's where you could continue to see further downside. So I think that takes away from this market cap another 5 to 10% correction, I would argue.
I mean, 5-10% correction, it still leaves you significantly higher than the last 5 years.
And that's the US, right? And all of that's not Europe, that's not MSCI EM, that's the US, right? And because all of that has been in the US. I don't believe we're in a situation where US investors are going to feel confident that this is the right time to get back into Europe, this is the right time to get back into EM. I think those investors are going to stay home at this minute.
At what point does the rout actually impede the Fed from raising rates?
And the bar for that is very high. That was stated in the Fed minutes, and that was also stated.
So like a meltdown.
Yeah. Well, I think not a meltdown. A meltdown is a very large sell-off. I don't think we're going to get sort of a 50% sell-off in the S&P. I think even if the S&P goes down by another 5 to 10% slowly, I don't think that's going to change the Fed's mind. Remember that the bedrock of this economy, the credit market, is not in trouble. U.S. high yield spreads are actually very tight. Levered loans, which is something that Yellen has spoken about recently as a warning sign, is not really turning red right now. So growth is still quite strong, and I think it will remain strong for the next sort of 12 to 24 months. And in that sort of a situation, companies should give you decent earnings. And in that case, you know, the U.S. market, for the U.S. market to decline 50%, I think is going to be quite hard. It was an expensive market. Earnings, Amazon, they're not coming through. Growth stocks are going to come further down, but a meltdown, I don't think that's very likely. And I think the Fed, therefore, in this world is going to continue apace.